A month added to a voyage. $2.5 million extra per trip. When tankers are forced to reroute around the world's most critical maritime choke points, every barrel of oil gets quietly more expensive. And that cost doesn't stay at sea. So here's the question this video answers. Who actually ends up paying that bill? The Strait of Hormuz and the Bab el-Mandeb, two narrow corridors of waters sitting at opposite ends of the Arabian Peninsula, have long been the jugular veins of global energy supply. When tankers operating near those straits face threat environments serious enough to force rerouting, the numbers become staggering fast. Reuters has reported that avoiding these choke points can add roughly a month to a voyage and around $2.5 million in additional costs per trip. That's not a rounding error. That's a structural shift in the economics of moving oil. And as we'll see, it doesn't take a full-scale conflict to trigger it. Just enough uncertainty to make insurers, ship owners, and charterers recalculate the math. By the end of this video, you'll understand exactly who absorbs that $2.5 million and why the answer is almost never who you'd expect. To understand what's happening here, you need to understand what a maritime choke point actually is, and why a handful of them hold the entire global economy in a kind of permanent, low-grade tension. A choke point is simply a narrow stretch of water where geography compresses shipping lanes to the point that there's no practical alternative. The Strait of Hormuz, sitting between the Gulf of Oman and the Persian Gulf, is perhaps the single most consequential stretch of water on Earth for energy markets. A vast share of the world's seaborne oil passes through it. Crude loaded in Saudi Arabia, the UAE, Kuwait, Iraq, and Iran all funnels through this corridor. The Bab el-Mandeb, at the southern tip of the Red Sea connecting to the Gulf of Aden, is the gateway to the Suez Canal route, the shortcut that links Asia and the Middle East to European and American markets without circumnavigating Africa. These two straits sit at either end of a critical artery. Block or threaten one, and tankers face a detour. Block or threaten both, and the detour becomes enormous, potentially rounding the Cape of Good Hope at the southern tip of Africa, adding weeks to voyage times and burning fuel the entire way. Here's the crucial point. You don't have to physically block a strait to disrupt it. You just have to make it risky enough that the insurance premium for transiting it becomes prohibitive, or that charterers start demanding rerouting as a condition of doing business. Perceived threat is often enough to reroute global commerce. So how does the cost machine actually work? There are several interlocking layers, and they compound on each other in ways that aren't obvious from the outside. Start with war risk insurance. Every commercial vessel carries a baseline insurance policy, but when a ship enters a designated high-risk zone, and these zones are formally listed and updated by the maritime insurance market, a separate war risk premium kicks in. That premium is quoted as a percentage of the vessel's insured value, and it can move dramatically in a short period when geopolitical tension spikes. A tanker that cost almost nothing extra to insure on Monday can become significantly more expensive to insure by Friday if the threat environment shifts. Ship owners typically pass this cost directly to whoever has chartered the vessel. Then there's the rerouting cost itself. If a tanker avoids the Red Sea and Bab el-Mandeb entirely and swings around the Cape of Good Hope, the voyage from the Gulf to a European port can stretch by weeks. That means more crew days, more fuel, and these vessels burn serious quantities of fuel per day. And the ship itself is tied up longer, meaning it completes fewer voyages per year. Fewer voyages means less revenue capacity for the same fixed asset. That's a squeeze on utilization that owners price into their rates over time. Speed is another variable. Tankers often slow down, a practice called slow steaming, to conserve fuel on longer routes. But in threat environments, some operators actually increase speed through risk zones to reduce exposure time, which burns more fuel and partially offsets the savings from slow steaming. Then there's the charter rate itself. When a significant number of vessels are suddenly taking longer routes, the effective supply of shipping capacity in the market tightens. Fewer ships are available at any given moment because each one is at sea longer. When supply tightens and demand stays constant, charter rates tend to rise, sometimes sharply. This is the compounding effect. Higher insurance, higher fuel, higher crew costs, and higher charter rates all hitting simultaneously. $2.5 million extra per voyage, in the Reuters reporting, is the sum of these layers stacking on top of each other. And that figure can be conservative depending on the vessel class, the route, and the duration of the disruption. Now here's where it gets personal, because this is the mechanism by which a geopolitical event in a distant strait ends up inside your economy. Oil is not consumed where it's produced. It moves enormous distances by sea, and the cost of moving it is baked into the price of the barrel when it arrives. When shipping costs rise, whether through higher charter rates, insurance premiums, or longer voyage times, the delivered cost of crude goes up. Refiners who buy that crude absorb the higher input cost, and refiners, like any business, pass input cost increases downstream when they can. That means higher costs at the refinery gate, which flow into fuel prices, which flow into transportation costs, which flow into the cost of virtually everything that moves, which is virtually everything. The transmission isn't always fast, and it isn't always complete. In competitive markets, some of the cost gets absorbed at various points in the chain. But it never fully disappears. It gets distributed. Beyond the direct price impact, there's a second-order effect that's arguably more important in the long run. Supply chain uncertainty. When the route is unpredictable, buyers start holding more inventory as a buffer. They contract further in advance. They diversify suppliers. All of these responses have costs. They represent capital tied up in stock that would otherwise be deployed elsewhere, and administrative complexity that consumes real resources. There's also a financial market dimension. Energy-linked assets, from the equities of shipping companies to the bonds of oil producers to commodity futures, all carry embedded assumptions about transportation costs and route reliability. When choke point risk rises materially, it forces a repricing of those assumptions. That repricing can ripple across portfolios that have no obvious connection to oil tankers at all. So let's bring this back to the question we opened with. Who actually pays that $2.5 million? The honest answer is, everyone in the chain pays a fraction of it, and the split depends on the structure of the contracts involved and how competitive each segment of the market is at that moment. Ship owners absorb some of it when they can't pass through full cost increases into charter rates. Charterers, often the major oil companies or trading houses, absorb some of it directly. Refiners absorb some. Distributors absorb some, and consumers absorb the rest in the form of marginally higher prices for fuel and the goods that depend on it. What this event illustrates is a mechanism that has repeated throughout maritime history and will repeat again. Geography concentrates risk, concentrated risk inflates cost, and inflated cost distributes itself invisibly across the global economy. The Strait of Hormuz and the Bab el-Mandeb are not just strategic concerns for navies and governments. They are toll booths that can be activated by conflict, by threat, by perception alone. And every market participant with exposure to energy prices, to shipping, to global trade, or to inflation is, in some sense, downstream of those two narrow strips of water. Understanding that mechanism doesn't require tracking every headline. It requires understanding that the world's most critical resources move through the world's most vulnerable geography, and that when that geography becomes contested, the invoice gets mailed to all of us. If this kind of structural analysis, the mechanisms behind the headlines, is what you're looking for, subscribe to Investors Club Global. We publish regularly, and every video is built to stay relevant long after the news cycle moves on. Drop a comment below. Which choke point do you think carries the most systemic risk to global markets right now?